Hi, let's go through a bond valuation example and see in practice what we've been discussing so far. So let's tackle this problem. If the annual market discount rate is 6%, what is the value or price of a 3-year bond that pays interest annually, has a par value of $1,000 and a 7% coupon rate? Let's take some notes based on the information we've got. The annual market discount rate is 6%. This is the rate we'll use to discount the bond's promised payments. In bond markets, this is called the bond's yield to maturity, YTM. I will denote this with Y, Y for yield. We want to calculate the bond's value or price. We will denote this with V sub 0, V for value, or alternatively, P sub 0, P for price. We use the subscript 0 for time 0, and this value or price will equal the present value of the bond's promised payments, that is the coupon payments and the par value that we'll go through in a moment. This is a 3-year bond, so the maturity date is year 3, and it pays interest annually. To relate this with the bond features discussion, this is equivalent to saying that it has a periodicity of 1. The par value equals $1,000. The coupon rate is 7%. And remember that in the previous video, we defined the coupon rate as the annual interest as a percentage of par. So in order to get the interest or coupon payments, we need to multiply our $1,000 par value by the 7% coupon rate. This will give us a $70 coupon payment. So what we basically need to do is discount 3 $70 coupon payments, one in each of 3 years, and the par value in year 3, and then sum up all these discounted values. Let's do this after depicting our payments on the timeline as well. As you can see, I already transferred the payments on the timeline. We have $70 in year 1, $70 in year 2, and $1,070 in year 3. The last payment comprises of the last coupon payment and the par value of $1,000. So the value or price of the bond equals 70 over 1.06 to discount the first payment at year 1 and take it to year 0, plus 70 over 1.06 squared to discount the second one, plus 1070 over 1.06 to the third to discount the final payment at year 3. This will give us the following values and a final sum of $1,026.73 rounded to 2 decimals. Notice that the price of this bond is greater than its par value of 1,000. Therefore, the bond is trading at a premium to par or simply at a premium. And to give you a bit more context, this makes sense. Can you think of the reason? Pause the video and think. Assuming you went through your thought process, the reason is the 6% market discount rate or yield to maturity can also be interpreted as the rate of return that investors require in order to invest in this bond. So investors require 6% and this bond offers them a 7% return, the coupon rate. Since it offers them more than the required rate of return, they are willing to pay a premium to purchase this bond. That is, pay a price that is higher than the bond's par value. Now I'd like to close this video with an aside. So it's appropriate to drop an aside alert. In this problem, I use the terms value and price interchangeably. That is as if the two are the same. And if you ever taken a finance class, you will observe that this is commonly done in some modules. In reality though, the two are not necessarily equal to one another. And in cases where the two differ, this has some potential implications, as it could give rise to what are called arbitrage opportunities. That is, opportunities to realize a risk-free profit by taking certain actions. And we'll see this in practice as we move on. For the time being, we assume that value and price are the same in the sense that they will have the same monetary amount assigned to them. Take care!